What happens when a regional conflict crosses the point of no return? On June 22, Iranian state media officially confirmed that the supreme leader had been killed following coordinated U.S.-Israeli airstrikes, alongside former President Mahmoud Ahmadinejad in a separate targeted operation. This was not rumor or social media noise, it was broadcast confirmation. Within 24 hours, the response was immediate and unprecedented. Iran launched 165 ballistic missiles, 2 cruise missiles, and 541 drones in a coordinated retaliation campaign. According to preliminary defense reports, 152 ballistic missiles were intercepted, yet dozens penetrated air defenses. More critically, Iran targeted a U.S. aircraft carrier strike group with 4 ballistic missiles, signaling a direct challenge to American military presence in the region. Iranian Revolutionary Guard statements declared there are now no red lines, framing the escalation as open-ended confrontation rather than limited retaliation. Markets, expecting de-escalation, were forced to reassess in real time. This is no longer symbolic posturing, it is structural escalation. If you want clear, data-driven breakdowns without hype, subscribe to GB Economy, because understanding the timeline, the numbers, and the implications matters more now than ever. As missile exchanges intensified and both sides signaled no retreat, the pressure point of the conflict shifted from military targets to global energy arteries. The Strait of Hormuz, the narrow maritime corridor between Iran and Oman, handles roughly 20% of the world's seaborne oil trade, equivalent to nearly 20 million barrels per day. By June 23, shipping data showed approximately 150 oil tankers and LNG carriers had dropped anchor in open waters rather than risk transit. The waterway is not officially closed, but it is functionally frozen. War risk insurance premiums for a $100 million tanker reportedly jumped from around $250,000 per voyage to $375,000 within days, a 50% surge that immediately reprices global energy logistics. Without insurance coverage, vessels cannot legally sail, even if the strait remains physically open. The shock extends beyond crude. Qatar, the world's leading LNG exporter, relies almost entirely on Hormuz for outbound shipments. Any sustained disruption threatens a significant share of global liquefied natural gas supply, particularly to Asia and Europe. Energy markets reacted accordingly, with Brent crude trading 8–10% higher, near $80 per barrel over the weekend and holding gains. This is not speculative volatility. It is a negative supply shock rooted in logistics and insurance constraints. When 20 million barrels per day face interruption, the consequences cascade through inflation, trade balances, and global growth forecasts. As energy flows through, Hormuz stalled, the battlefield expanded beyond open water into fixed infrastructure. By June 24, strikes were reported near key commercial ports across the Gulf, signaling a shift from targeting vessels to targeting logistics hubs themselves. Facilities in the UAE, including areas linked to Jebel Ali, which handles roughly 60% of the country's imports, faced drone threats, while Oman's Duqm port, strategically developed to bypass Hormuz chokepoints, was also reportedly targeted. In Bahrain, areas near Mina Salman, home to both commercial shipping lanes and the U.S. Fifth Fleet presence, were placed on heightened alert. Israel's port of Haifa, a critical gateway for energy and industrial imports, was similarly drawn into the risk perimeter. The strategic logic is clear. Ships can reroute, but ports cannot move. By pressuring cranes, storage terminals, fuel depots, and container yards, Iran shifts the confrontation into economic warfare territory. Disrupting port infrastructure threatens supply chains far beyond crude oil, affecting food imports, manufactured goods, petrochemicals, and military logistics. This is not symbolic retaliation. It is calculated pressure designed to raise insurance costs, freeze trade confidence, and reprice global energy risk in real time. While ports faced pressure and oil logistics stalled, another fracture line appeared, this time inside the precious metals market. Over the weekend of June 22–23, when traditional Western exchanges were closed, physical and tokenized markets continued trading, and the divergence was stark. In thin, dark market flows, gold reportedly touched $6,000 per ounce. PaxG, a tokenized physical gold product trading on crypto rails, moved near $5,400, roughly $124 above Friday's Western spot, close around $5,278. Silver showed an even sharper disconnect. IG weekend trading indicated levels near $100 per ounce. Shanghai spot silver traded around $105, with Shanghai futures near $108. In Shenzhen's physical buyback market, premiums reportedly pushed real transaction levels close to $120 per ounce. Meanwhile, Western spot silver had closed Friday near $93. That implies an approximate $27 per ounce premium in Chinese physical markets over Western paper pricing. This is not a small arbitrage gap, it is a structural signal. When physical buyers in Asia pay materially above futures settled prices, it suggests tight supply conditions or distrust in paper settlement mechanisms. Crypto-linked precious metals trade continuously, reflecting real-time demand, while COMEX remains closed. If futures reopen without adjusting toward these weekend levels, arbitrage pressure becomes unavoidable. Physical markets traded all weekend and they revealed where immediate demand is willing to transact. When physical premiums widen and energy routes freeze, capital does not scatter randomly, it concentrates. 3 assets now sit at the center of this repricing cycle: gold, silver, and oil. Gold is functioning as a monetary reset hedge. As of late June, it has recorded 7 consecutive record highs in major markets, reflecting central bank accumulation trends that have exceeded 1,000 metric tons annually in recent years. In a geopolitical escalation scenario, gold absorbs safe haven flows first because it carries no counterparty risk. Silver, however, is not just a monetary metal, it is an industrial bottleneck. Solar panel production, EV expansion, AI data centers, 5G infrastructure, and defense manufacturing continue to draw physical supply, while mine output growth remains structurally constrained. 10 consecutive monthly green closes in silver prior to this escalation suggest underlying tightness even before geopolitical risk accelerated. Then there is oil, the one asset that cannot be printed, digitally created, or policy adjusted into existence. With roughly 20 million barrels per day exposed to Hormuz disruption and Brent trading near $80 after an 8–10% weekend spike, energy pricing feeds directly into inflation expectations. When gold, silver, and oil rise simultaneously, it signals not sentiment-driven volatility, but necessity-driven repricing. However, disciplined analysis requires acknowledging the countercase. Weekend premiums, especially in crypto-linked metals markets, often exaggerate directional conviction due to thinner liquidity. A $27 per ounce premium in Shenzhen over Friday's $93 Western silver close is structurally significant, but it may not fully translate into Monday's futures open. When COMEX reopens, gold and silver contracts can gap sharply higher, only to partially retrace as liquidity deepens and arbitrage flows normalize spreads. We have seen this pattern during prior geopolitical shocks, including March 2020 and October 2023, where initial futures spikes were followed by rapid intraday compression. De-escalation remains a variable. If military operations slow or diplomatic backchannels emerge within days, insurance markets could recalibrate, allowing some tanker traffic through Hormuz to resume. Energy premiums would compress, easing inflation expectations. Additionally, coordinated bank interventions during periods of extreme volatility are not unprecedented. Liquidity injections, margin adjustments, or futures positioning shifts can temporarily suppress price momentum. None of this invalidates the structural tensions outlined earlier, but it does introduce timing risk. Markets rarely move in straight lines. Even in escalation cycles, sharp pullbacks can occur before the broader trend reasserts itself. At the core of this analysis lies a structural signal that should not be ignored. When physical markets transact materially above paper-settled futures prices, it reflects more than temporary speculation, it indicates stress in real supply channels. As of the June 22–23 weekend window, Western spot silver closed near $93, while reported Shenzhen physical transactions approached $120 per ounce, implying a premium of roughly $27. That magnitude of divergence cannot be explained solely by thin liquidity. It suggests tight physical availability, localized demand urgency, or distrust in paper settlement mechanisms. Similarly, tokenized gold instruments such as PAXG trading near $5,400 while futures markets remained closed highlight how crypto-linked metal platforms provide continuous price discovery when COMEX is inactive. These venues may be smaller in scale, but they reveal where immediate buyers and sellers are willing to transact in real time. When physical and tokenized markets lead, while paper markets sleep, the spread itself becomes the message. This is not investment advice, and it is not a prediction of guaranteed price direction. It is financial warfare education, an examination of how geopolitical escalation, energy choke points, and physical supply stress translate into market signals. As futures reopen following the June 22–23 weekend divergence, the critical variables to monitor are clear. First, the size of the opening gap in gold and silver contracts relative to Friday's close. If silver closed near $93 and physical markets signaled levels above $100, the adjustment mechanism will matter. Second, whether the reported $27 physical premium in China compresses or widens once global liquidity returns. Third, how oil responds if Hormuz insurance constraints persist into the trading week, especially with Brent already holding near $80 after an 8–10% spike. These are measurable indicators, not emotional narratives. Gold, silver, and oil are repricing around necessity, not sentiment. Watch the gap, watch the premium, watch the duration of disruption. Thank you for watching the video. If you hold a different perspective, share your view in the comments below.